Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's Monday morning, March 17th, St. Patty's Day. I inadvertently put on a green sweater this morning, but there's no Irish in me, but I'll celebrate with the Irish nonetheless. Our note this week was titled Over. Did you say over? That's a reference to our soft patch growth scare that we first wrote about 3 weeks ago in our note titled Cleaning Up the Industrial Policy Mess. That was a more obtuse way of saying what Secretary Bessent said in a far more colorful way, which was we need to go through detox from our addiction to government spending. And our idea 3 weeks ago, before Treasury Secretary Bessent went on CNBC, actually 3 days after we were on CNBC saying essentially the same thing, was this idea that we would cut government spending, which would weaken growth in the first half, with the labor market being a particular point of vulnerability, and that it would take at least until the second half for private sector capital investment to regain momentum after 2 years of weakening amidst what we call the industrial policy mess, which was also described by Treasury Secretary Yellen as modern supply side economics. It was really just government spending on renewables and the like, as opposed to letting the market decide where to allocate capital. And in our view, it didn't work, right? And so we're now into a soft patch, and we spent a lot of the note describing what's happened so far and what we expect going forward. We then discussed the inflation numbers last week. We described it as, or characterized it as, domestically driven disinflation, meaning the housing and super core non-housing services parts of the report came in below trend. And that's what the Fed should be focused on. They got off the track for the entire last decade, focusing on disinflation being driven by global forces via goods prices, when they should have been focused on domestically driven housing and non-housing services inflation. That's actually been true for the last 2 decades. And it contributed to the housing bubble, no doubt. We then went on to describe the data we got on the labor market last week from the JOLT survey and Atlanta Fed wage tracker series that we really like. We called that unstable NAIRU, meaning the labor market's not contributing to inflation, but it is not stable right now. And a bunch of layoffs from government workers and contractors could really tip the balance in the labor market. We'll be watching for next month's labor data in particular. We then previewed the Fed meeting a little bit. We're still very much in the camp the Fed will be cutting rates aggressively. 3 weeks ago, 4 weeks ago, when we were talking about this on Kelly Evans' show, which, by the way, will be on shortly today, sometime between 1 and 2, the market had moved away from our call for a full 1% of rate cuts this year. Market's kind of coming back our way. And we think as the data unfolds, it will come even more towards our target. We think the first cut will be in May, and then wrapped it up with our market view, because the market has reached our 10 to 12% target for the equity market decline, and it reached our 420 target on tens in the first week. And so we think you should be nibbling a little bit here, but do think it'll take much longer for the data to unfold. And we may not get all that much of or all that many hints around a policy pivot by the Fed this week either. So going back to the soft patch, we've definitely seen a weakening of business confidence, consumer confidence. And we had a number of discussions last week that the Trump policy agenda may be off the rails because of trade policy. I think that's a legitimate concern. We still continue to maintain that the Fed and investors should be far more focused on the impact of cuts in government spending than they should be focused on trade policy. Any inflationary effect would be transitory. We're in the transitory camp, so we feel justified in saying that. But that's a first order effect. The second order effect would likely be disinflationary or deflationary. Excess capacity in China remains super abundant. So this is just starting to unfold, and that's why we titled the note the way we titled the note. I've mentioned inflation already. We do have disinflation in the parts of the inflation dynamic, housing and super core services, that the Fed should be focused on And that we think will create the space for them to be able to cut rates in response to a weaker labor market. And again, you should be buying here. We're not comforted by relatively tight credit spreads. We think that the money that's flown into private credit has masked a lot of the risk that we would typically be seeing in, that IG credit CDX market or high yield market. And we could get a disorderly widening of credit spreads if the economy does deteriorate significantly from here. It's not our call. We don't think we're going in recession, but nor are we comforted by, this morning's retail sales number, for example, which so far quarter to date, retail sales are flat, and that's coming off a 4.2% fourth quarter gain in personal consumption expenditures. So, there's lots of evidence the economy is weakening, and the Fed really should be focused on government spending, not the first order effect of tariffs. That's it for us this week. Again, consider becoming a full subscriber. You'd have been in on all the details 3 weeks ago, and you could be trading accordingly. Barry Neff from Ironsides. Thanks, everyone. Have a good week.